This is an interesting period we're entering, and a lot of it has to do with the fact that we've been in this economy that's slowly weakening, right? So even before the oil surge, where oil went to $120 a barrel, we're looking at a market that had problems, right? The labor market was starting to weaken, consumer spending was getting weaker, people struggling because of inflation. These are all other aspects that are coming into play now. The tariffs obviously have hit the economy and the US and really the globe quite a bit as well. And so generally looking at the market, I'm generally longer term bearish now. And I do think we're even at a point where we could say the S&P has topped out for even the next few years, even potentially longer. And so generally looking at the things that I look at, it's not a rosy picture. We'll have great bounces along the way, but just be very careful. And I think that's so important because the narrative obviously out there is that oil is the main culprit here. But if we remember, just going back to February, that was before the big oil run. And there were a lot of issues already, right? We had PPI data, which is inflation data, starting to spike even before this oil run. And we saw the labor market after the US put out its yearly revisions 2 years in a row, basically a million less jobs to a point where the labor market was stagnant. And so I do want to just mention to people is that, sure, there's going to be a ridiculous rally when oil comes down, and it will come down back to the 70s, maybe even lower. But just don't think that it solves all the problems. That's the narrative that it's going to be spun to get retail investors to buy the dip, right? Buy everything thinking the markets are going to all-time highs. But there's still a lot of underbelly issues, including this private credit market or private loan issues that we've been hearing more and more about from the AI spend that's been going on. So you have these software companies that have really been taking on massive amounts of debt. Oracle's, to name one of them, $100 billion in debt. But there's other companies that are smaller that have been spending, honestly, drunken sailors, just thinking that they have to get ahead of this AI curve to make money. And the problem is that not all of them are going to be right? There are going to be losers in this field, just like we saw in the dot-com bubble back in 99, 2000, when that crashed in the early 2000s. And there were a lot of bankruptcies, and you had a lot of scenarios where companies went down 90, 95% during that period. And so you have to understand is that the companies are assuming that they're going to make X amount of dollars on their spend, and therefore they can pay the debt. And they've gone to the banks, they've gone to the private credit markets and said, hey, if you give us this loan, we can pay you back X fold because we expect this return. Problem is, if you just see a little bit of a slowdown, and let's say the adoption on AI doesn't go as quickly as possible, all of a sudden these loans go into the default side, and we're already starting to see that in the markets, in the private credit market. And that's a $2 trillion market. So it's a potential time bomb that's already starting to go off. I think it's important to understand is that probably a majority of that GDP 0.7 was this massive spending by Meta, Microsoft, Google, the rest of them. They all announced, $200 billion for the year in terms of spend. And so I would argue that the economy probably would be in recession if it wasn't for this massive AI spending. And that it really tells you why we see the consumer struggling, because the consumer's not doing so well. Unless you're in this AI build out where you're making $1 million plus a year, you're basically left behind. And again, then you have prices that have continued to rise. And albeit we've gotten the inflation rate down to like 2 to 3%, but that's still every year 2 to 3% higher. And now it's looking like it's going to spike even more. And so, all these ancillary factors are putting a lot of pressure on the economy. And then you look at the US government, where we had this early in the year 2025, this Doge that was supposed to cut all this spending. And here we are surpassing 39 trillion in debt, spending even more quickly than prior to that Doge period of cuts. And it's all a recipe for, number one, the government stimulating, but it can't go on forever. Eventually, the market and the powers that are buying our US debt, they're going to say, nope, we're not buying anymore unless you pay us 10% interest rates. And then the whole house of cards comes tumbling down. It does to the aspect of the damage it's doing to the underlying economy, right? So right now we are dealing with an oil shock. There's no doubt about it. I mean, gasoline US has gone up about 30% or so from where it was, maybe 35%. And obviously everything, right? Plastic is made with oil. I mean, the combines that are cutting the wheat, right? They're all using energy. And so the longer it takes to get oil prices down, the longer it's going to filter into food prices and all prices that we're paying, especially coming off of this last inflationary cycle. We're at a point where the consumer is really stressed already. How much more can the consumer take, right? I mean, in this year, we've always been like, oh, the economy runs on consumer spending, which is true. But at some point, point does the consumer break? And then you look at certain data points like delinquencies on credit cards are spiking dramatically, telling you people are unable to pay off their credit card every month. 90-day delinquencies, in fact, are spiking. Auto loans are getting now delinquent, and we're seeing a spike there. So there's no doubt there's already a consumer or the public that's hurting. The question is, how long does oil stay up? And then how much more hurt does that put on? And essentially, does it become the straw that breaks the camel's back? I would say this: there's no avoiding a recession. It's coming. The question is, does oil make it come quicker than it otherwise would have? If you look at the weekly jobless claims, which is people filing for unemployment, it's been kind of stationary around 200,000, which historically that tells us the labor market, you're not seeing a ton of layoffs yet. I do think that is about to change. And I also would argue that the immigration policy that the U.S. has taken on has artificially kept that number low, right? So you have a lot of immigrants that had or were in jobs, they're getting taken out of the workforce. And essentially it's keeping other people in jobs from getting laid off because there's kind of this labor market. But you're right about the CapEx spend. That's stimulative. But now imagine, like, let's say the average mega cap is spending $150 billion a year in AI spend. Now, what if they just cut it back to half of that next year? Let's say in 2027. All of a sudden, you take out, let's say, $500 billion in spend from the economy. Can the economy actually hold up in that face of that kind of reduction? And I would argue that considering as weak as we already are, that's a recipe right there to push us into recession. And that's not even taking into account higher oil prices or rising inflation or other issues out there. One of the things I found as a trader that focuses on the charts is that when I let myself kind of get enveloped data, right, and looking at the data in my head, it's like, well, we should be entering a recession right now. And what we know is that in general, we can see longer periods where rollovers or recessions, getting into them at least, it can be extended out. Long term, I think gold is an amazing asset, right? It's stood the test of time. Thousands of years, people have prized gold, jewelry, gold coins, etc. But there's an issue here with gold, and this is why I still think it's going lower before it bottoms out and then eventually makes new all-time highs. Gold has been reacting as a risk asset, just like silver. And that's telling you that basically weak hands bought gold in the run up that we saw to 5,600, that basically were buying it not because they were trying to be careful with their money, but because they were trying to get rich quickly. They thought it was an asset that was just surging to the upside. And what I found in all my studies is that when you have an asset that flips like that, it means until it goes down enough to wash out those players, it doesn't start behaving and bottoming out until it does. And so really what I'm expecting is a move down to 3,500 in gold, at which point the people that bought in around 5,000-ish or so, they will eventually dump in despair. And finally, you'll get it back to be an asset that starts behaving inversely to the stock market, meaning that when there's fear, people run to gold versus what's happening now, which is when there's fear, people are selling gold. So the central bank buying is what tells you long-term gold is ultimately going to bottom out and then eventually move up and probably go to $10,000 an ounce. Is that there's a new world order forming here where there's kind of a place. It's a very long process, right? It doesn't happen in a year or in days or weeks or months. But basically other countries are saying the US has become too powerful because of the dollar and its reserve currency status. We need to diversify away from fiat currencies as a whole and have something that actually has stood the test of time, right? Because, all fiat printed, and you go back to, England back a long time ago. I mean, all of the reserve currencies, they eventually kind of peter out. Actors start printing and they start to get diluted. And so you have to look at it like that. And these central banks, they're the smartest people in the room. If they're buying gold, it tells you where the long-term fiat currency system is going. So, I mean, for sure, I've obviously bought silver and I'm holding some long-term positions as kind of a insurance. If we get down to 3,500 here on gold, I would absolutely be buying more of it. Same thing on silver. Silver, if we look at this, I wouldn't go near silver personally until it gets low enough. But we get down to this $49, $50 level down here, there's a massive amount of support. I'll start accumulating that. And certainly I do have some Bitcoin, right? Again, Bitcoin is kind of the new block, if you will. So there's obviously I'm not holding as much in Bitcoin as some of these other assets, but I think those are places you want to be. Real estate, I'll be interested in, but only when it corrects massively. I still think there's 50% downside at minimum in real estate before it bottoms out here in the US. Way too much upside. And again, the prices are just unsustainable. And you're already starting to see it crack, as you mentioned earlier on, in the real estate markets here. And again, what's amazing is if you even go back to just before COVID, home prices almost doubled from there. So, I mean, we're not, 50%, maybe I'm too conservative on that in terms of how much downside there could be. The problem is that's going to create create an even harder issue for consumers, right? Because their biggest asset is their home. They've always assumed it's going to generally grind higher in value. They can use it for retirement purposes. And if we see a 50% plus haircut in home prices, think about what the consumer's reeling from. The 10-year yields had this massive move up. And what a lot of people don't understand here is that the 10-year yield was at 3.9% about in early March. Here we are, and it's at 4.3%. It basically was the equivalent of a 50 basis point rate hike by the Federal Reserve. Now, listen, the Fed didn't hike rates, as we know, but the market, remember, the Fed controls the short end. The market controls the longer term yields, which is actually what sets mortgage rates and a lot of other things out there. And so with the move up in oil, you could argue that there has been casualties, right? This impact on other assets. And in this case, rates going up, inflation is going to jump, and it has caused yields to go up. And that again puts more pressure on the economy via higher interest rates, as if the Fed had hiked rates. I think stagflation is what we're entering here. Now, again, like we talked about earlier, it's a matter of when oil comes down, can it kind of get back on? But it will take months for this to kind of filter out. Inflation, it goes back to $70 a barrel tomorrow or next week, and all of a sudden the inflation evaporates, right? It's now in the system. It's going to take some time to get out of the system, no doubt about it. Usually inflation occurs in bull markets in expansionary periods, and people can handle it because they're making more money. Worst case is when the economy's shrinking and people are making less, and then you also have the upward push on prices.